Crude oil just exploded higher, not by a little, nearly 12% in a single move. And when energy markets move like that, it doesn't stay contained to oil traders on Wall Street. It spreads quickly into things farmers feel first: diesel fuel, fertilizer production, and cost of moving grain around the world. At the same time, severe thunderstorms are sweeping across the Midwest with confirmed tornadoes and damaging winds, while a major heat dome is building across the western United States that could accelerate drought conditions. So tonight, the real question isn't just where grain prices are sitting today. The real question is whether we're seeing the early signs of another input cost surge heading into planting season. Let's break down the markets, the weather risk, and the major news shaping the markets that feed America. This is Boots and Bushels. Corn futures are trading near 447 per bushel, up slightly on the day. It's not a dramatic move, but the quiet stability in corn is actually telling us something about where the market is right now. Corn traders are balancing two competing forces. On one side, global supplies are still relatively comfortable. South America continues moving a large crop through export channels, and that has limited the upside momentum of corn futures recently. But on the other side, corn is extremely sensitive to input costs, and that's where today's crude oil move becomes important. If energy prices stay elevated, fertilizer production costs can rise quickly. Nitrogen fertilizer in particular is heavily tied to energy markets because natural gas is a major input in the manufacturing process. If farmers begin to worry that fertilizer prices could spike again, it can quickly change planting decisions. Some producers begin looking at alternative crop rotations, sometimes shifting acres toward soybeans where fertilizer requirements are lower. That possibility may not be priced into the market yet, but it's exactly the type of scenario traders start watching when crude oil suddenly jumps the way it did today. For now, corn is steady, but this is a market that could react quickly if energy markets stay volatile. Soybeans are trading near 12.14 per bushel, showing a stronger move than corn. And the soybean market has a few supportive factors working in its favor right now. First, soybean demand remains solid. Global vegetable oil markets continue to show strength, and soybean oil demand tied to renewable diesel production has been a major driver over the past few years. Second, energy markets can sometimes spill directly into soybean markets. When crude oil rises sharply, the market often begins to talk about increased demand for biofuels. That includes renewable diesel made from vegetable oils like soybean oil. So a strong energy market can quietly support soybean prices through the biofuel channel. There's also a planting decision factor. If fertilizer prices begin to climb again, soybeans suddenly look more attractive from the cost standpoint. They require significantly less nitrogen fertilizer than corn, which means they carry less input risk for farmers worried about rising costs. So while corn remains relatively stable today, soybeans are showing a bit more strength, and that difference between the two markets can sometimes tell us where farmers may be leaning when planting decisions start getting finalized. Chicago wheat futures are trading near 597 per bushel, showing one of the stronger moves among the grain markets today. Wheat tends to be the grain most sensitive to geopolitical developments, and that's important right now because global shipping and energy risk are both increasing. The energy market is closely tied to export logistics. Large volumes of wheat move through major shipping lanes, and disruptions in energy markets can quickly translate into higher freight costs and tighter global supply chains. If fuel prices rise significantly, the cost of moving grain around the world also increases, and that can influence export competitiveness between major producing regions like the United States, Europe, and the Black Sea. So wheat often reacts earlier than corn when global risks begin to rise. The move higher today may be reflecting exactly that. Oat futures are trading near 343 per bushel, showing a weaker performance compared to the other grains. Oats tend to trade in a much smaller and less liquid market than corn or soybeans, so price swings can sometimes look more dramatic. But oats are also influenced by feed demand, livestock production, and broader grain market sentiment. If feed costs rise because of stronger corn or wheat prices, oats can sometimes find support as an alternative feed ingredient. For now, though, the oat market appears to be lagging behind the broader grain complex. Live cattle futures are trading near $231.58 per hundredweight, continuing to hold historically strong levels. The cattle market has been one of the strongest stories in agriculture over the past year. That strength is primarily driven by supply. The U.S. cattle herd remains historically tight after several years of drought forced producers to reduce herd size. Fewer cattle in the pipeline means tighter supplies, heading into feedlots and eventually into the beef supply chain. That supply tightening has supported cattle prices, even when other agricultural markets have struggled. Demand for beef has also remained resilient despite higher retail prices. Consumers have continued purchasing beef products, and strong restaurant demand has helped support the market. But cattle producers are also extremely sensitive to input costs. Feed prices, fuel, and fertilizer all influence the economics of raising cattle. So if energy prices remain elevated and input costs begin rising again, that could eventually create pressure on the cattle feeding margins. For now, though, the cattle market continues to show remarkable strength. Feeder cattle futures are trading near $348.68 per hundredweight, essentially flat on the day. Feeder cattle are closely tied to feed cost, especially corn. When corn prices rise sharply, feeder cattle markets often feel pressure because the cost of feeding animals increases. Right now, corn remains relatively stable, which is helping feeder cattle maintain their strong price levels. But again, energy markets could play an indirect role. If fertilizer costs rise and farmers begin planting fewer corn acres, it could eventually tighten corn supplies. That's a longer-term scenario. But it's exactly the type of chain reaction traders start thinking about when crude oil jumps the way it did today. Lean hog futures are trading near 94.48 per hundredweight, slightly lower on the day. The hog market continues to navigate a balance between strong domestic demand and global trade dynamics. Export demand from major buyers like Mexico and Asian markets remain an important driver for hog prices. But hog markets can also respond quickly to feed costs. If corn and soybean meal prices begin rising significantly, it can squeeze profit margins for hog producers. So the hog market will also be watching grain markets closely as planting season approaches. The biggest market story today may actually be outside of agriculture. Crude oil is trading near 97.47 per barrel after surging more than 11%. That is a massive move for the oil market. Moves of that size usually signal some type of disruption or risk developing in global energy supplies. And right now, that risk appears to be connected to the escalating tensions affecting shipping through the Strait of Hormuz, one of the most important oil transport routes in the world. Roughly 20% of global oil supply normally moves through that narrow waterway. If shipping disruptions occur there, even temporarily, oil markets can react quickly, and the ripple effects spread across the global economy. For farmers, that means watching three key things: diesel prices, fertilizer production cost, and freight rates for moving grain. When oil moves sharply higher, those three costs often follow. Weather is also becoming a major story across several key farming regions. Across parts of the Midwest and Mississippi Valley, severe storms have already produced damaging winds, large hail, and confirmed tornadoes in some areas. These storms can create localized damage to grain bins, farm infrastructure, and equipment. They can also delay early spring field work in regions that receive heavy rainfall. At the same time, strong winds across parts of the plains have raised concerns about soil erosion and difficult conditions for fertilizer application. Meanwhile, a major heat dome is building across the western United States. Temperatures in some areas are expected to run 20 to 30 degrees above normal for this time of year. That kind of early season warmth can accelerate snowpack melt in mountain regions that supply irrigation water to western farms. And if snowpack melts too quickly, it can create water shortages later in the growing season. So while severe storms dominate headlines in the Midwest right now, longer-term drought concerns may be building across the western half of the country. Both of those weather patterns are worth watching as the planting season approaches. Now some agricultural news. The biggest agriculture story developing right now is the potential impact of energy disruptions on fertilizer markets. The Strait of Hormuz is not just important for oil shipments, it's also a major shipping route for fertilizer products and raw materials used in fertilizer production. Several countries in the region export significant amounts of nitrogen and other fertilizer inputs through that corridor. If shipping disruptions slow fertilizer exports, global fertilizer prices can move higher quickly. Some analysts are already reporting rising fertilizer costs in global markets. That matters because fertilizer represents one of the largest input expenses for many crop producers. Corn production in particular relies heavily on nitrogen fertilizer. If prices rise sharply, it can influence planting decisions and farm profitability. Farm groups are already warning that fertilizer price increases could erase some of the income improvements farmers were hoping to see this year. So the energy market move we saw today is not just an oil story. It could also become a fertilizer story, and eventually a grain market story. So when we look at today's markets, the real takeaway may not be where corn and soybeans finish the day. The bigger signal may be coming from energy markets. Crude oil jumping nearly 12% is the kind of move that can ripple through the entire agricultural economy. It can influence diesel prices, fertilizer production, and the cost of transporting grain around the world. At the same time, severe weather across the Midwest and heat building in the West are adding additional uncertainty to the growing season outlook. So while grain markets are relatively steady today, the underlying risk facing farmers may be increasing. And those risks are exactly what the market will be watching as planting season moves closer. Because in agriculture, the biggest price moves often start with the pressures farmers feel long before harvest. And that's what we'll continue watching here on Boots and Bushels, the markets that feed America. If you want daily updates on the markets that feed America, subscribe to Boots and Bushels.